It is a little bit of the future, actually, because if you think about 4 or 5 years back, nobody really thought about Europe as a residential investment market itself. So it has also a little bit of a futuristic aspect in it, although it might not be that futuristic as the last session we had. One of the things why these kind of European story now is something people start to think of, I've pointed out on this slide, because it shows on the left the evolution of ownership, home ownership rates in Europe. And that was mainly the story why a lot of institutional players simply were not looking at this market. Because we had increasing ownership rates for the last 50, 60 years. There was a high effort to get everybody on the housing ladder. There was, if you look on government programs or speeches of political representatives of the national governments, they all wanted to keep everybody on the housing ladder. And that was one of the main goals. And then in 2007, 2008, the financial crisis set in. And everybody realized that home ownership in itself has no economic value. So it's associated with a lot of risks. And what we see right now, it starts in Southern Europe already, that home ownerships start to stabilize. And in some countries, they start to decrease again, because sometimes people are not able to afford anymore a house, because prices might have corrected but not enough. Banks are less likely or less willing to give you a 100% or 110% loan to buy something, especially if you're a graduate and just entering your professional career. So it's much harder now to really enter to come on the ownership ladder. On the one side, on the other side, at least in some countries, it's starting to become acceptable to live in a rented apartment for a while. At least if you're just a graduate, enter your professional career, it's quite acceptable today now, even in the UK, that you don't live in your own apartment. So you're not stigmatized anymore, just not owning the apartment you're living in. So that also changes the whole framework. And that's also one of the situations why a lot of institutional investors start thinking about residential again. When they think about residential, okay, there are at least one market they're always thinking of, that is Germany, the country also Patrizia is based in. And that's natural because we have by far the largest private rented sector. But going, let's say, 12, 18 months back, one of the markets that came into focus in the last let's say 1.5, 2 years, is the Dutch market. It's not because it has a large private rented sector, it's because you have a lot of change in the social housing sector. The housing associations that operate in the sector, they ran into difficulties due to the financial crisis, and therefore structural changes are now underway that offer opportunities in this sector. Then you have these government initiatives in the UK that try to establish a private rented sector. Funnily enough, at the same time, they try to establish first-time mortgage buyer support, which is a little bit contradictory on that side. So the government initiatives are not that, let's say, clear-cut and structured in a consistent way. But also there you see government initiatives. If you look at countries like Spain, where also structural habits are changing, Ireland is one of the markets. 5 years back, nobody would have thought of Ireland as a residential investment market. In the last 2.5, 3 years, a lot of international capital entered the Dublin market and really established an institutional rental market in Dublin right now. So we see a lot of changes in this tenure structure we have in Europe. And going forward, I'm convinced that this is a chance really now for institutional players to benefit from these structural changes on the way. And on the other hand, one of the big challenges we still have in Europe is the unemployment rate. And the unemployed should move to where they are needed. But if you not have a functioning rental market, it's quite hard for an unemployment person to move to another city, buy an apartment to be able to live and work there. Because if you're unemployment, you're normally not that credit quality the banks would like to have you to have it. So that is also one of the things, if we want to solve this unemployment challenge we have, a functioning rental market might not be the solution, but it will help to really get labor more flexible to move around. And the other thing is, everybody is talking now in the industries about urbanization and about growing cities. Yes, we are getting more urbanized, but one thing you should not forget about this urbanization, we have this general trend of urbanization and cities growing, but at the same time, in most countries, you see some cities declining. It's not only about growing cities, it's also about declining cities. And you have to really analyze these urbanization trends into detail to understand what's going on. The resi market is heavily influenced by these. So we have a shortage and an oversupply in urban areas of resi at the same time, and that is also one of the challenges you have to keep in mind when dealing with investments in the sector. And one of the things investors should always be aware of is the effects of regulation on performance. We have a lot of initiatives on the regulatory side currently underway, and if you look at the picture of regulation across Europe right now, you have on the top right-hand corner, you have Sweden as a heavily regulated resi market across Europe, followed with a distance from countries like Germany and the Netherlands. And the funny thing of Germany and the Netherlands is why I want to point it out, is in the Dutch market you're seeing government initiatives to really get regulation out of the sector, to change the point system, to get more private involvement or to get more private capital to the system, because you have a shortage of supply. In Germany, we also have a shortage of supply, but we try to regulate more. So being an economist now, we have the chance for real-world experiment, what creates more housing, more regulation or less regulation. Given that regulation don't build houses, I'm quite sure what the answer will be to that, but we will see how this evolves going forward. And on the other hand, you have markets like the UK and Finland. They are the less regulated resi markets on the one side, but given the UK's obsession, at least in the past, with home ownership, there was no chance to get a rental market established. And given the current political situation, as I mentioned already, it might be a challenge if we really see that going. But if you look at investment flows, regulation in itself is not holding back any investors not to invest in Sweden or Germany. They go there as long as regulation is predictable. So that's also one of the things going forward. A lot of governments try to establish a rental sector, and before it's really going, they talk about regulating this sector. The UK is one of these good examples. You still don't have a rental sector, and they're talking about rental caps or rental regulation. That's not a good, stable situation to get a sector going. So that's also one of the challenges when you operate in this. You have to understand what's going on in these sectors, and you have to be local. It's not like a shopping center portfolio you can manage from one country across Europe, because, okay, legislation is local, but it's more or less you have the same tenants everywhere. If you have H&M in France, in Germany, in Belgium, and in the UK, it more or less behaves the same. But if you have a household in these countries, they behave different, they act different, and they have different needs and different requirements. And that is the other thing what a lot of people attract to the resi sector. The rents are quite, let's say, stable and increasing. The only examples are France, which had a negative trend for the last years, but is stabilizing now. And given the financial crisis, it is quite reasonable why you had it in the past. But you see a strong stabilization, and in countries like, in cities like Madrid and Barcelona, you've seen the turnaround. And you have the Dutch market, which had also some challenges, but it's also, I have to say, that's the private rented sector that's very small in the Dutch market itself. So overall, maybe coming to the end saying, why are investors attracted to resi? It still offers a decent premium above government bonds. And if you look at the risk side, given the granularity of the tenant base, it's a quite secure asset that doesn't have so much higher risks associated with it than a government bond. Because if you decide for real estate, you're aware of the fact that you're investing in an illiquid asset. So yes, you need a premium for that, but that should be not so great because you're accepting illiquidity in the moment you're decided for resi. And that's also something we should keep in mind, therefore, that there is room for yields possibly in the resi sector to compress further. Nevertheless, historically they have been very low, and they still, given the low government bond yields currently right now, look very attractive, forming a basis for interesting investments going forward. And how can you invest? You have the traditional core investments, buy and hold. Fewer investors are doing that because they have a quite low return. You have a large value add sphere that can be repositioning buildings, turning on offices to resi, doing breakup sales, buying a block and selling it unit by unit. That's where a lot of the story in resi is currently taking place. And that's not always associated with a much higher risk, but associated often with higher returns. I think the opportunistic end in resi is currently not the turf the investors are going for. Doing resi development in declining cities might be opportunistic. It can be profitable, but I think that's not the story when you come to resi, what the investors are currently looking for.